let's go to deal 3 with our very good friend, Mr. David Horry. So David, the floor is yours.
Yes, excited to be here. This is mine and Jeff's first red light, green light, and we're excited about the learnings. And we're excited to get feedback from this group because this is different from any of the other deals that we've seen so far, at least come through this group. So I'm excited to get some feedback on this. So at a high level, we are working on a commercial real estate lending company acquisition. And this acquisition involves 2 operating companies. And we'll refer to them as we talk and move forward as lending and holding to kind of differentiate them. And that'll make a difference as we kind of look at the numbers. Go ahead and click forward, please. The team, Jeff is driving this presentation, and he is upper echelon. He has over 20 years of real estate investment experience. He owns his own lending company in the real estate space and has 15 years of experience with that. He runs 4 Reg D funds. And so he brings a lot of expertise in that's specific to this deal to bear. And then there's me. I've scaled 3 different startups that have exited via acquisition. And so I'm the scaling side of things and kind of focused on growth. So a brief snapshot on the business. There's 2 real components. So again, the lending side, what we refer to as lending, focuses on commercial bridge. They're a commercial bridge mortgage broker. And the holding side focuses on structured installment sales of commercial properties. This is based in my area, Idaho. It's been around 20 years. There are 2 owners, and they are the business. So there are no employees. Real estate is negotiable, and we'll touch on that in a little bit. And then revenue. There's 4 streams of revenue. So there's origination fees, there's loan servicing fees, long-term escrow fees, and then interest income from trust accounts. And so if you're not familiar with structured installment sales, it's a vehicle that a lot of people will use when they're selling commercial real estate to minimize the tax hit. So whoever's buying this commercial property will engage the holding company here. They'll send the money to them, and the holding company basically makes payments, regular payments over 30 years to the original owner of that property. But what that allows them to do is to invest that money and collect dividends and interest and charge servicing fees. So that has been a very lucrative piece of the business on the holding side. So we did some SWOT analysis, and we'll start with the strengths. They're very well established and have a lot of industry credibility. You know, when I started talking to Jeff about them, he already knew about them, right? From his experience, and was aware of their reputation. So, and he's all the way on the other side of the country. So even though they operate in kind of a small local geo, they're well known. They're also very vested the owners are in remaining in the business. They're angling to structure the deal such that we would guarantee that they get to stay on in their current capacity for the next 5+ years. So they're, again, very committed to the long-term growth of the business. Other things worth, I think, highlighting is that they're very conservative in how they've structured deals and the kinds of deals that they've gone after. And they always, they err towards simplicity, right? Like, don't overcomplicate things, and they're tech enabled. So there's also a good amount of recurring revenue, and that's something else that we like about this business. Weaknesses. So again, the owners are the business, and we are acquiring a job, and both Jeff and I are aware of that. We have a plan both for hiring a key employee, and we know what we're signing up for, and we have a path out of it too, but just calling that out. Also declining revenue in the last year, so you'll see that in the one sheet. And then not the highest seller psychology is what I would call out. On the opportunity side, There's, one of the things we'll see is that the holding revenue or the holding company's revenue is declining, but there's, I think, a good chance that it could rebound. I actually feel very optimistic about it, but we're modeling it like it won't rebound. We'll get into that in just a second. Let's see, other opportunities, cross-selling between Idaho and Wisconsin, basically Jeff's company and the company we'd be acquiring. There's also 2 Reg D private offerings that they're not currently utilizing that we could spin up. And then Boise is just growing a lot. So it was the 5th fastest growing company in the US in 2022, 2023. So a lot of growth. Residential has been softer, but commercially there's a lot that needs to be put in place to support the growth. Threats. IRS regulatory rulings, that's what's kind of is pending, that makes the holding side, the revenues have taken a hit. There's a key man issue, right? Like one of the owners in particular has a lot of kind of historical information in his head, and so hiring a key employee and then getting, Jeff and I embedding ourselves in the business will help de-risk that. And then certainly transfer of value. Carl talks about that. Like we need them to stay in the business for an extended period of time to ensure that investors and their connections all come over in the business. So that's just a snapshot of SWOT analysis. So we'll look at the numbers here. And again, I've broken it out by the lending and holding companies. And the lending was what they built their business on. And what they realized was the holding required a lot less work and was way more lucrative for them. And so they started doing more and more holding and backburnered lending. But last year, structured installment sales hit the IRS dirty dozen. And if you're familiar with that, that just means that they're watching people that utilize this particular, tax loop. And because of that scrutiny, they decided, again, they're very conservative. They were going to pause any kind of new business on the holding side. And so you'll see revenues go down subsequently. And they're subsequently then spinning back up the lending side that they have backburnered for the last few years. And they're just kind of playing it conservative until the IRS either says, where our thoughts are is that the IRS wants to scrutinize this so that, to encourage people to utilize this as it's intended, and then go back to business as usual. But they may come out with a ruling and we'll have to tweak things. But again, we're kind of modeling it like the holding side never comes back and that we're just going to build out the lending side. Hopefully that makes sense. We can talk about it when we get to the one sheet. That's what we have so far. Any questions before we jump into the numbers on the one sheet?
Nope. Let's look at the numbers and then we'll chat about it.
All right.
While Jeff brings that up, I think the thing that we have going for us is really, really strong seller rapport. This is a broker deal, but it's a back pocket deal. So the broker's not involved. We get to talk directly to the owners. Even in the most recent term negotiations, I started sensing like something was off. And so I just popped by the office, chatted with them. They are very transparent. They talked about exactly what they wanted. And so we have a really strong seller rapport with these guys. Jeff, did you want to make any comments about the one sheet? I've been kind of dominating the conversation.
My comment is actually more about the 2 sellers. The 2 sellers are what I would call educated business owners. They actually understand the valuations, and they also understand the fact that because they made a conscious decision to scale back a little bit on the holding company and that revenue, that hurts the valuation of the company, and they're not asking for purchase price based on delusional past revenues that they're not making anymore. So when David talks about them being transparent, I honestly had no idea that you could actually run into sellers that actually understood the buying side. quite so well and be so easy to work with and just have conversations with. So as you kind of look at the one sheet, you can see, you know, from a year ago, it was 1.5 for EBITDA, and it more or less got cut in half because of their decision to pause things, right? And under normal circumstances, that'd be a little concerning to see a company lose 50% of its revenue. For me, having been in the lending space for the past 15 years, to me, that's not that big of a deal because to drive that revenue right back up is actually fairly easy. It's the fun thing about it's a double-edged sword, really, with that revenue. Lending companies have very, very low expenses, and it's ridiculously high gross margins. We have very few write-offs. I mean, it's all W-2 income, you know, except for all the interest income that we can drive. But all the fees and all that stuff, you know, it's there. So this is actually a pretty easy business for us to drive up. I've already got a team of people in place here in Wisconsin that are driving my business. And so for us to plug into this business and bring some of those resources across to the other business is actually a fairly easy thing to do. David's going to be local with it. The two owners want to stay. Their attitude is, we want to sell the business. They have some need for the money or want for the money that they haven't disclosed. So they want to sell, but they also want to stay in because to them, this is like a playground. It's just a whole lot of candy and brain candy and game. And, you know, they're not really ready to get out of the game. They're just ready to not be the business owners anymore.
Okay, cool. All right. Let's hit some analysis on this, guys, because we're running out of time. Jeremy Bronson, what do you think? Complex deal for me, but what are your thoughts?
Yeah, I guess the two biggest questions I would have are on the balance sheet. I think we're missing maybe an asset there to get to the $1 million mark. Or I'm just not sure where those total assets are coming from, but how much of that cash is actually needed to continue on with what you're doing? Because are you needing $6 million of working capital to continue to operate the business? I think that's one of the biggest questions that I have.
Yeah, it's a good question. They are actually planning to take the cash out, not because they don't understand the need for it. Well, there's not really a need for it. The operating cost is paid for basically with 1 month of interest that they earn. So it's paid for in the first month of the operating year. They're taking it out though because they don't want to leave it in and inflate the value of the business and then pay 6% to a broker on it. So they're going to pull it out. They're willing to leave, you know, what we need in there. They're willing to loan us some, but they don't want to just leave the 5 million in there and then pay 6% on it.
Right. Gotcha. Yeah. I think that's probably the biggest thing I guess one of the biggest things that I would have is how much working capital does the business actually need to continue to operate? And then the other point I would have is, you know, there's some, again, on this one, some huge add backs, you know, 1.1, 1.6 million 1 year. So what are all those add backs that they have in there? I would want to dig into those.
Sure.
Cool. Kyle, anything to add?
Nothing too crazy. Like I said, you know, just the revenue to margin thing. I just haven't seen much of that before, but nothing too specific.
Yeah. Okay. Yeah. I think this is too hard a bucket for me. I'm really struggling to understand the business model in a lot of detail. Just seems like you need a ton of capital to make these kind of margins. And I'm just curious what that cost of capital is and, you know, how you make that work. But I know you guys are from this world. Darren Yee, I know you're from the real estate world as well, and now you're doing deals in private equity. Can you get your head around this?
Yeah, so I actually had a good conversation with Jeff and David around this earlier in the week, so it's cool to kind of see them jump on and get some feedback from everyone. But kind of a couple pieces in this is like, one, to get this deal done, like it's going to be hard to find funding for it, right? Like I turned around and asked a few people I knew in the SBA lending side, commercial space, and all of them just said, there's no way we're lending on a lending company. So that presents a challenge in itself. So you might have to find a way to find private investors and things like that. But I also kind of turned around to Jeff, because he has a background. He's got a few other funds. And I kind of turned to Jeff and I said, why not just start another fund, then go and acquire a $2.4 million fund, right? Like, I think your capital to start a new fund, right, versus like buying a fund, like, I can tell you we didn't spend $2.4 million to start ours. So, and he has the experience and expertise, go raise the capital and then go lend it out, right? Like, that was kind of my perspective on it. But I said, I'd love to just see what other people say, but I think, you're going to have some challenges. You're right. Like, can't get SBA is not doing it. I've talked to a few, commercial lenders, they're not doing it, right? So you got to go kind of raise some private capital to go take this thing down if you don't have 2.4 mil. But I still go back with Jeff's expertise in funds and having his own.
Yeah.
I still almost lean again, go back, just start your own fund if if
I think that's really good advice, right? Like, why raise capital to buy a business that does this? Why not just raise the capital to do it, right? So 99 times out of 100, I'm always going to tell you guys, buy a business, don't start one. But you can be up and running in days, doing this yourself, and then you're not paying back any capital for the privilege. You're just generating the returns through through the way you're trading the money, and you're making those margins. So but you know what, like, this is a market where Jeff in particular and David, they're the kings of this space. I'm not really a real estate guy. I'm not a big fan of financial services companies generally, because they're crazily heavily licensed, and the sort of things you've got to go through with like the SEC when you're managing people's money. There's all sorts of things in change of control, vetting. They get involved. They do a whole bunch of things. It could massively delay like any closing process. So yeah, I think this is one of these rare instances where I think, based on your absolute expertise in this industry, and your ability to raise money, which is what you're already doing, I would just go do this. If this is an industry that you're really passionate about and you can scale, you're better doing it yourself rather than buying into something like this. So, but those are my thoughts. But have a great rest of your Thursday, everybody, and I'll see a bunch of you guys tomorrow.